Cool. Welcome, everyone, to our monthly Bench2Market talks. My name is Morgan Greenleaf. These are monthly talks for new entrepreneurs out of Emory, Georgia Tech, University of Georgia, and Morehouse School of Medicine. I'm with the Georgia CTSA, and this series is co-sponsored by Biolocity and the Georgia Tech Parker H. Pettit Institute for Bioengineering and Bioscience. Couple of quick announcements before we get started. If you are at Emory or Georgia Tech and you are working on something, Biolocity has pro bono innovation office hours. You can contact Biolocity and speak to them. They do run an annual solicitation for funding for new biotech and medtech innovation out of the two universities. But if you want to talk to them at any time, you can contact them and schedule those office hours. Just to save the date, the next in our series is going to be FDA Regulatory Strategy, April 16th from 12 to 1, and you can see the full series on the Biolocity website. So I'm super pleased today to have Connor Seabrook with us. He's going to talk to us about investment and dilution for companies. So if you don't know Connor, he has been around the medtech ecosystem as a mover and shaker for many, many years, and is Vice President and Managing Director of the GRA Venture Fund. Hopefully you'll talk about GRA a little bit as well.
I will.
Yeah? Okay, good. So now I'll give you this.
Well, thank you, Morgan. Good afternoon, everyone. I'm delighted to be here with you. My name's Connor Seabrook. As Morgan said, I'm a Vice President at Georgia Research Alliance, as well as the Managing Director for the GRA Venture Fund. Let's see, are we queued up on? Oh, yeah, okay. So very quick introduction about me and my background. I have an MBA. Prior to that, I was working for a commercial bank on Wall Street, making loans to basically people who didn't need them. I got my MBA, then I went to work for Goldman Sachs. And then in 1988, I joined a venture capital firm. At the time, it was the world's largest venture firm, also publicly traded. I've subsequently worked for several different firms since then. So I've basically been in the business since '88. I don't even want to do the math about how many years that's been, but I've seen a lot of cycles of companies growing and some difficult fundraising times. I would say over the course of my career, from an investment perspective, it's probably about over 300 companies that those firms have invested in. So I've seen a lot of different types of technologies being brought to the market. The one common theme amongst them was that they were all early stage companies at the time of investment. So I assume you're here because you want to learn about starting a company. Maybe you have an idea for one. So let's talk about that. You've probably mentioned it to your significant other. You probably mentioned it to your friends, your colleagues. They've tried to talk you out of it, but you think it's such a good idea, you're going to pursue it anyway. And I would say that with regard to starting a company, it is all-consuming. It is challenging. It is stressful. It's also incredibly rewarding. And based on the building that I'm in, I'm assuming you're going to be doing something that's going to benefit patients. And so it's nice to know that you're actually going to have a positive impact on patients' lives if you get your product through to the market. So it's the one thing is, though, early stage startups, there's not a lot of resources. You're doing everything, certainly in the beginning. So one of the things I would encourage you to think about is, and you're going to need to know these things when you go to talk to investors, because you got to convince them as well as when you start hiring folks. But you got to convince them to go through this, to share your vision and to go through this process with you. So what problem fundamentally is being solved? And again, based on where I am, there's probably regulatory approval clearance that may be necessary, but is not necessarily sufficient. The big issue, in effect, that I see a lot of startups make is that they do enough studies to get the regulatory approval. They think the FDA is their customer. The FDA is not their customer. It's a necessary step. It's an important hurdle. It's a big milestone, but you may need a lot more data to convince the insurance companies to reimburse for that product. So I constantly see companies, they don't get enough data to get to the payers in effect. So ideally you have an unmet medical need, but if you don't, you need to understand the value proposition. In some way, it's got to be faster, cheaper, better. Hopefully all of them. If it's better, how is it better? And who's going to be the decision maker to buy it? Who's going to pay for it, which I just referred to? And amongst the users, what's the impact on their workflow, their daily workflow? Are they going to have to change everything, or is this neatly fit into what they do on a day-to-day basis? So this slide kind of talks about the progression, the typical progression of financial resources that are obtained. And by the way, I want to give a shout out to Bill Zarotny and Katie Vest at Jones Day, who did a similar talk not too long ago. They were nice enough to share their slides with me, so I've kind of borrowed some of their concepts as part of this. So I want to give them credit for that. But basically, the idea, you're going from an idea, and you need to establish the proof of concept, and you have to get to the reduction of practice. And by reduction of practice, what I mean is, it's one thing to prove that it works in a lab in a perfect environment. But when you get out into the real world, it may not work. We had one example I can think of. We had a company that had a sensor, and it worked great in the lab. But when they got it out in the real world, where you have wide swings in temperature, humidity, there's dust, there's pollen, all kinds of things, they could never get it to work right. And they spent a lot of time, a lot of years, and a lot of money trying to perfect it, and they never got there. So you have to reduce it to practice, and it has to be scalable, reproducible. And then once you have your product finalized and hopefully approved, then you're ready to go to market and scale up. So you're going to need some resources along the way to get that. And by the way, these resources that I've listed here, I intentionally did not align them with the various steps because they're not necessarily linear, and you can use them at any time. So for example, we'll talk about the various types of resources that you can obtain, but non-dilutive, you think about grants. We have companies that even today, they already have several $1 million of revenues. They're still getting grants because it's a great way to fund your company and not give up equity. Bridge loans can occur at any time in the beginning or between, round C and D if you need to extend the runway. So you can get bridges safe at any time. And then equity. And then we'll talk about, and interestingly, there are other non-dilutive sources at the end of the cycle that you may be able to access that a lot of people don't think about. So we'll talk about all that as we progress through this. Oh, the one thing is, if you are raising equity, it's got to be from an accredited investor. And we'll talk about what an accredited investor is. So generally, when you raise money, you're relying on the Reg D security laws exemptions. And I've listed here what an accredited investor, the typical qualifications that enable you to be an accredited investor and invest in private equity or something that's not registered with the SEC. So the big ones are individual net worth of over $1 million, that excludes your home, or have income of over 200 or joint income of 300 over the 2 most recent years. So you can only raise money from an accredited investor. So then we get to the types of financing resources, which I just kind of talked about earlier. But so grants and loans are non-dilutive. Obviously, you're not selling any equity. You've got safes and convertible debt, which are non-price financings, but are likely to convert to equity when you raise a priced round downstream. You have dilutive equity financings. We're actually selling a piece of the company. And then, as I mentioned earlier, typically later on the company's development, there's some non-dilutive sources of cash, such as non-recurring engineering cash payments that you can get from strategics. If they want you to develop a particular feature for your product that doesn't currently exist, they might pay you to do that, and then you can apply it and sell that product to everyone else. You can also have a strategic relationship, and strategic investors sometimes will give you upfront cash in order to gain access to your product. They may include milestone payments as you progress further to the market. and you may receive royalties based on sales. So there's other ways, other non-dilutive sources of cash once the company matures and gets further down the line. So as Morgan said, I work for the GRA, so I'm going to give a little pitch for the GRA. Did you have a question? Want to go back?
Yeah, for the non-price financings, does that require accreditation?
Yes, because it's going to convert. It's likely to convert. So once it converts, those investors will need to be accredited. And then become accredited? Yeah. That's a good question. I'm not an attorney. I don't want to speculate on that. I'm guessing that no, they probably have to be accredited at the time they make the investment. Any other questions? Okay, so one pitch. So I'm a part of a 3-member team, colleagues, Justin Burns and Andrew Short, you may have met. But we're the innovation and entrepreneurship team at the GRA. We provide grants and loans to startup companies. We get funds from the state, and our grants are milestone driven. They do go to the university, but we don't pay overhead. So 100% of the money goes to the lab of the researcher. And then we also have loans that we can provide to the companies themselves. And the nice thing about the loans is, and by the way, the terms of those loans are intentionally favorable. But the nice thing is by going directly to the companies, there's less restrictions on what those funds can be used for. And if you're interested in applying, my colleagues at Emory OTT, Quadrant I can guide you in the application process. At the end of the day, our objective is to position the company to be able to raise outside capital and to support their continued success. The state invests in us because they want economic development. They want jobs here in Georgia. From the university's perspective, they want to monetize their intellectual property. They have a big investment in these facilities. They have a big investment in the research that goes on here, in the faculty, the grad students, and they want to see a return for that. So they will license that technology out to a startup company. That startup company raises the capital. And in return, the university will typically get their patent expenses repaid. They may get equity in the company. They may get royalties from sales. It's a negotiated process, but they'll get an interest in the success of the company. You had a question?
Yes, I kind of touched on it right there, comments, but for the IP that's pursues, say, the commercial loan, that has to have some sort of Georgia Tech or Emory connection.
Yeah.
It can't be like an IP that has no connection or IP that's been leased as opposed to license.
Good question, and I should have been clear about that. So to be eligible for the GRA grant and loan program, yes, because we're state funded, our mission is to take the inventions, discoveries, ideas from the university and get them into the marketplace. So there has to be a connection or some sort of ownership by the universities. And obviously the grants are going to the university. So, but thank you for that clarification. Any other questions? And this just kind of talks about, so again, grants go directly to the university, loans to the company. Won't spend a lot of time there because I got a lot of slides to go through and I'm probably running behind time. And then on the, this just gives you a little bit of a picture of our success. So you can see over the last 10 years, GRA has awarded $34 million, mostly in grants, but some loans. We've funded over 200 projects. You can see we've got about 1,200 jobs. And just in the last fiscal year alone, our company's raised $140 million in equity and generated nearly $200 million in revenue. So it's hopefully been a good return on the state's investment in the GRA. All right, so let's go back to what we're here to talk about, which is non-dilutive grants. So the nice thing about grants, and you guys probably have applied for or received grants, so you know all this, so I'm not telling you anything that's new, but you retain 100% ownership in your company. You're not giving anything up, right? There's no obligation to repay a grant. And a grant, depending on the source of the grant, it can convey credibility about the program because they're typically peer reviewed. So to an investor or to someone looking at you for the first time, that actually can convey some credibility. Now, cons with it is that there's an application process with an uncertain outcome at the end of it. The types of things you can spend the money on may be restricted. there can be a long lead time before you hear whether your grant's going to get funded or not. And then there's can be some uncertainty about the exact timing of when you're going to get those funds. And you don't know if you're going to get approved for the next grant, if there's a phase one, phase two. So there's a lot of uncertainty about grants, but we have a lot of companies that very effectively use them to supplement their other capital that they've raised. So if you need, in other words, if they need some certainty about capital, they can raise an amount of money and then apply to grants to supplement that. So I definitely encourage people to try. Might as well. So where do you get the non-dilutive grants? Well, you can get them from, universities themselves have grant funding themselves. Georgia Tech, Emory has a grant program. Georgia Research Alliance, I mentioned, Biolocity is available. There's NIH grants, SBIR, STTR, America Seed Fund. There's nonprofit organizations such as the CF Foundation. If you have technology that can benefit cystic fibrosis patient, you can apply to the CF Foundation, Bill and Melinda Gates Foundation. We have a couple companies that have gotten grant funding from them. So depending on what it is that your technology is addressing or what problem it's addressing, you may find organizations that are interested in funding that type of activity. So it takes a little research on your part to do that, but you can do it. Another possible source of non-dilutive, sometimes you can join an incubator. They typically will provide you resources in exchange for equity. So it's not really non-dilutive because you do have to give up some equity, but depending on the terms, it may be attractive. The other thing I wanted to mention is that there's a program that's run out of UGA called Fast Track, which provides money, I think up to $3,000 to hire a grant writer for you. So if you don't have time to write your grants, or if you want someone to review to hopefully give you a better possibility of receiving the grant, there is money available that you can use to hire your own grant writer. So next is loans, venture debt. I mentioned the GRA has a loan program. Again, the pros, you do retain ownership in your company. You're not giving up any equity. Typically, loans do come with some sort of equity kicker. So there may be warrants. The warrants are typically not meaningful in the terms of the cap table, but there usually is some sort of kicker. There is an obligation to repay, and that may be difficult if you're operating a loss or you have negative cash flow. So the terms may not be compelling. You got to pay interest. There's going to be a repayment period. There may be collateral in the form of your IP, inventory, receivables. It's likely to be senior to other debt and liabilities, and it may include an a personal guarantee, which I always try to dissuade my entrepreneurs from signing. Some do it anyway. One other possible source of non-dilutive capital is there's a new entity called Trial Capital Solutions, where they will fund part of a clinical trial. It's kind of an interesting model. They believe they have an algorithm that enables them to predict the likely success of any given clinical trial with enough certainty that they've been able to secure insurance. So they provide debt. So in effect, you have to raise some equity, but you can match, you don't have to raise 100% of the equity to finance a clinical trial. You can supplement it with their debt, and their debt is secured by insurance that they buy. If the trial fails, the insurance pays off the debt, so you're not responsible for that. If it's successful, then obviously, hopefully the company has significantly increased its enterprise value, will be able to raise money at a higher value in the future, and then can use that money to repay the debt that way. So in effect, it enables you to raise less money to get further along down your path to getting to the market, and you can repay the debt with less expensive capital. Morgan.
Fascinating. They don't take equity, just take a loan.
Yeah, an interesting model. I don't. So I've heard of this program. None of our company, I think a couple of our companies have applied. No one's ever actually implemented it. So I don't know the details of it, but you could probably look it up online, and or if not, I think I have a contact for them, so you can check with me afterwards, and I'll give it to you. You can investigate further. Let me know. So I don't know the answer to that question. But again, it's another way to leverage the capital that you've raised. Angela, are you looking it up right now? Are you going to tell us the answer? Oh, okay. All right, so then you get to the non-price financings. So the one a lot of people have heard about are safes. This is a great way to raise capital particularly quickly because it spares you the process of negotiating the valuation. It spares you the process of negotiating the terms. No equity is issued. There's no interest or maturity date like traditional debt would have. And from a legal perspective, they're pretty cheap. So it's a great way to kind of get money quickly into the company. Investors have no ownership or voting rights. So some investors may not be willing or able to participate because all they're getting is a promise that the money they're going to give you is going to turn into equity in the future. So for example, as a managing director of the GRA Venture Fund, I have a fiduciary responsibility to my investors. I would never invest in a safe. It's just not something that's going to happen. I suspect most venture funds take the same approach. But it does work well if you're an angel investor and you're making a decision for yourself. You have no fiduciary responsibility to anyone other than yourself. So if you're comfortable doing that, great, go for it. So a lot of companies raise money this way, but it's not for everyone. Let's put it that way. And it will convert to equity in the future. And it typically comes with a discount, so maybe like 20-25% discount to whatever price you raise money at in the future. And it also may have a cap on the valuation. So it will be dilutive eventually. And then there's convertible debt. A lot of the same benefits to the company. You get your money up front, no equity is issued. Again, it saves time because you're not negotiating the terms, you're not negotiating the valuation. Lenders will receive certain rights. Again, it's a lot less expensive than a priced equity round. So it's pretty cheap from a legal perspective to get the documents together. But obviously, there's going to be an interest rate that will accrue. It will have a maturity date. And similar to a safe, it's going to be converting at a discount or a capped value in the future. And then we get to equity. So when you raise equity, you're selling a portion of your company. And when you sell the equity, if you've raised a safe or convertible debt in the past, it's going to likely to include the conversion of that in those terms. So you've agreed to the terms, you've agreed to the valuation, got your investors lined up, and away you go. So there can be multiple classes or series of stock, and they could have similar or differing rights from class to class. And the process to get there is somewhat opaque, but hopefully the way it's going to work is that you're going to make a pitch or provide an investor deck to an investor, and that will lead to a meeting or meetings. And the meetings will lead the investor to want to learn more about what your business plan is and what you plan to do with the money. And you may ask them to sign an NDA, non-disclosure agreement. So they treat the information you're going to provide as confidential. And then hopefully that will get them into the diligence process. And the diligence process is pretty detailed. They're going to go through a lot. But at the end of it, hopefully you will have a term sheet. Sometimes you get the term sheet and it'll be based on completion of diligence. So there may be a couple items that still have to be finished. But basically, the idea is to get to a term sheet. A term sheet leads to formal documentation and closing. So that process does take time, which is why a lot of folks go to the safe and convertible debt initially. And you've probably heard the phrase, you got to kiss a lot of frogs before you find your prince. I think the most frustrating part about fundraising for equity is that you need to find a lead investor who's going to negotiate the terms with you. And it's very, very difficult to find a lead investor who is not knowledgeable about the space that you're operating in and is willing to put in the work. I know it's frustrating for folks, but I think I'll just comment on the venture business in general. There's kind of a rule of 8 in the venture business. So if you're a general partner at a venture fund, the rule of 8 basically says that you can probably handle no more than 8 investments at any one given point in time. So if you think about it, a fund goes out, it raises $100 million, $200 million, whatever it is. Each GP maybe is going to invest $20 million, $25 million. but they can only do roughly, they're probably looking at 2 deals a year. So over the course of 4 years, going to get up to 8 deals. And then they got to wait for one of those deals to roll off before they invest in another one. So the point is, they're seeing a lot of deals. And your deal may be great, but it's not just that your deal is great. You're competing with all the other deals that they're looking at out there to where are they going to spend their time and their resources. I mean, they are looking for the best return they can. So they have limited time, limited resources. You're competing against all the other deals that are coming in. A lot of it is timing. They may be leading around at the time you walk in the door and they just don't have time for you. So a lot of it's timing, or you may be at the end of a fund's life cycle and they don't have the money to invest at that point. So there's a lot of nuances that go into it. So it gets back to, you got to kiss a lot of frogs before you find your prince. That's just the nature of the beast. So with equity, it is dilutive. Investors are buying a percentage of your company, and we talked about, and we're going to go through some of this in more detail, but you've agreed on the terms that are summarized in the term sheet, and they generally fall into, I think of them as falling into 2 categories. One are the economic terms, which is the valuation. So if you are raising $5 million at a $15 million pre, you just sold 25% of your company because they now own 5 of the 20 post-money valuation, right? So you've given up 25% of your company. So there's economic terms, and there's also what I refer to as the command and control provisions, and we're going to talk about them in further detail. But these get into things like who's going to be on the board, and they're going to have certain rights, both veto rights and control provisions about what you can and cannot do with the company in the future. So those are equally important, and you definitely need a good attorney who is familiar with venture investments and early stage startups to guide you through what terms are acceptable, which ones you can negotiate, which ones are reasonable. When you raise an equity round, your attorney costs are going to be the highest, but I would say get the right attorney. It'll be worth it long term. And from the investor perspective, it's your highest risk because you're an equity owner, so you're junior to all the debt and liabilities, but you're also sharing in the company's upside because you're an owner. All right, so economic considerations. So we'll just kind of go through that. So pre and post money, you're also going to create an option pool. So on day one, you own 100% of the company, but now in my scenario, you've just given up 25% of the company, and the investor may want you to create a 15% option pool for basically for the recruitment and incentivization and retention of the employees. You're going to need a team, right? You're not going to do this by yourself. So typically it's 15% option pool. So not only did you give up 25% of the company, you just gave 15% away. So on day one, you own 100%, you just raised your first round of equity, and now you're, what's that, 25 plus 15. So now you own 60%. And you're going to have to raise money in the future. It's unlikely you're only raising one round. So you can see that over time, your ownership is going to be diminished. So again, with the economic considerations, so when the company is sold, the money that's received is going to get distributed to the investors based on the terms that you've agreed to. So if everybody's the same class of stock, then it's just pro rata, right? But everyone's typically not the same class of stock, and so there may be provisions that then dictate how they call it a waterfall because that's how the money is going to flow when and if you sell at the time. There may be a dividend that accrues that has to be paid. There may be a liquidation preference, a multiple that's required before the event. So let's say in my scenario, you raise $5 million. If there's a 1x liquidation preference, and you sell the company for $100 million, well, $5 million off the top goes to your investors, and then you might go pro rata to everybody. So you have to be and then, that's kind of called the double dip versus non-participating, which would treat everyone as converted to equity. So, I'm speeding through this. There's a lot to it, but the point is it does impact the economics at the end of the deal. And then I mentioned the command and control considerations. So as a reminder, if you create a corporation, the investors elect the board of directors. The board of directors hires the management team. The management team comes up with an operating plan that the board will typically review, approve, and then also approve the resources that the team needs to execute on the plan, right? So it's important who's on the board. And so preferred investors, they may want board seats. They may want preferential voting by class of stock that's sold. They may have veto rights. They may have protective provisions that dictate that you need their approval to sell the company or issue additional stock or debt, or to change the board, change the compensation. So again, as I said earlier, you definitely need a good attorney who's well-versed in these issues. Some other CNC considerations, vesting in founder shares. You may think you own 100% of the company on day one, but they may come back and say, well, no, your shares are going to vest over 3 or 4 years. So all of a sudden you don't own those shares. You have to stay with the company for some period of time. There may be anti-dilution provisions in the event of a down round. Hopefully you won't have to deal with the down round, but if you've raised money at a 20 million valuation, you run out of money, you haven't achieved the next milestone that enables you to raise money at a higher valuation, you may have to raise money at $10 million. So sometimes there's anti-dilution provisions, which mean the original investors are going to get more shares for their original investment, in addition to the money you now need to raise at a 10 million valuation. So there's a lot, needless to say, there's a lot of nuances here. That's why you need a good attorney. Right of first refusal, I think, is self-explanatory, drag along. That in that case, the majority forces the minority to agree with whatever decision they've made. Tag along, minority has co-sale rights, so one investor can't sell unless the other investors have an opportunity to sell. And then there may be some redemption provisions, meaning the company has to buy back investor stock at some point in the future. So I talked about this earlier, other non-dilutive. So when the company is more mature, this kind of comes into play, but you may be able to get non-recurring engineering fees, strategic deals that provide the cash front, provide cash payments that I talked about earlier. But the other thing that I talk about is, be a good steward of the capital that you raise, spend it wisely. I mean, you need to spend it to make progress, right? But the more you spend, the more you got to raise somehow. So you have a fiduciary responsibility to your investors. Be cognizant of that. So nobody here is asking me for advice when it comes to fundraising, but I'll provide some anyway. There's an adage that if you want advice, ask someone for money. If you want money, ask them for advice. Try and get them interested. Your business plan, whatever it is likely to take longer and cost more than you think. I have never, of the more than 300 companies that I've seen my venture firms invest in over my career, I've never seen one hit their original plan. It just does not happen. So, did you have a question? No? Okay. So, it will take longer and cost more, guaranteed. So therefore, if you can get the money and take it if you're oversubscribed, I tell people, and it's reasonable terms, take the money if you can. And do not get fixated in valuation. The CNC component of the terms of the money you're raising is important too, almost more important, I would argue. Down rounds can be extremely difficult, and likely no one is going to be happy if you have to do a down round. And I see entrepreneurs all the time that get all excited about, oh, I raised money at this big valuation. And then they run out of money, and then there's a down round, and then I guarantee you, nobody's happy. So don't get fixated on the valuation. Some investors will likely give you a nice valuation to convince you to take their money, but then this is going to be draconian. So again, having a good attorney that knows what's reasonable is important. Yeah, it's when you have to raise money at a lower valuation than you did last time. So you're giving up more. So in my example, if you raise you raise 5 million at 15 million pre, 20 million post, you gave up 25% of the company. So now let's say you got to raise another 5 million, and now you're raising it at 10 million pre, and so now 15 million post. So then you just gave up another 33% of your company in addition to the 25% you already gave up. And if the 25% has anti-dilution provisions, that 25% may turn into 30%. So now you've given up a lot more of your company than you had originally anticipated.
Cascade effect is not fun.
Exactly. And then you have to explain why the valuation went down. Investors aren't happy with that. It gets messy quickly. But you got to do what you got to do to, if that's your only path forward, then that's your path forward. You got to do what you have, whatever's needed for the survival of the company and enables you to progress. Yeah. So shareholder approval will be important. Yep, absolutely. That's required.
But to go back to your point about,
But-
actually, we just go back and watch Silicon Valley, and they had their like insane valuation. Part of the conversation is the valuation that you're getting actually legit? Or are they giving you much higher, and then they have CNC, and it's going to later force it down around because you're not going to be able to be successful?
I never saw the show because I live it every day. The last thing I want to do is like watch it. But yeah, but that's exactly right. I mean, and what's interesting is you do get some companies that are, Facebook, I think, is probably the most famous example that I'm aware of. But Facebook became a very hot deal, right? So every VC in Silicon Valley wanted to say that they were an investor in Facebook, and they were all scrambling to get into it. So the valuations that they were going to invest just to be able to say they were part of it got crazy very, very fast. Now, in their case, they were able to leverage it and keep going up, right? But I can think of a couple of local companies where California VCs came in, gave them a very nice valuation, and they haven't been able to live up to it. And now they're kind of stuck with, they're confronted with, do we raise down round? What do we do? We need more capital. How are you going to negotiate that? So, yeah, go ahead.
About sort of these trendy funding practices, does crowdfunding sort of play into?
Yeah, so crowdfunding, it depends on, I'd say it kind of depends on what you're trying to do. So VCs generally don't like a lot of investors on your cap table. And if you have crowdfunding, you've got a lot of individuals on your cap table investing a little bit of money. So I'd say in general, VCs are not fans of it. I personally am not a fan of it. But it certainly has its place. Again, you have to get money somewhere, and if that's a viable alternative for you, then you got to do it, right? But I think the biggest challenge is that your cap table is going to have a lot of investors on it.
Have you seen any companies that, this is what you're referring to, people are investing in, like it's one person on the cap table and a bunch of people invest into like some type of crypto stablecoin, and then have you seen anything like that?
Well, I haven't seen that, but I have seen special purpose LLCs be created. So in fact, a couple companies I know of where that was done. So the individual investors that were invested in the LLC. So the LLC appears as one investor on the cap table, and alongside the institutional investors. So they don't have a huge number of investors on the cap table that they have to go back to. So when you have to go back and get shareholder approval to raise more money, you're only going to the managing partner of the LLC and not trying to track down 50 individuals, right? Or whatever it is. So, any other questions about that? Okay. So fundraising, it's one step in a long progression. I mentioned this earlier. You have fiduciary responsibility for other people's money. People get all excited. They raise their money, and yes, it's, you should celebrate your achievements, but you will be constantly fundraising until you have sold the company, basically. You will always be fundraising, whether you are or you're not. When you meet people, you're always going to be trying to gauge interest. Would they be a future prospect or future potential investor? So you will be constantly spending your time fundraising, thinking about finding investors. Just because you raise one round, that's not the end of it. Even an IPO, I would argue, tell CEOs all the time, they get all excited to have an IPO. So, well, that's just another fundraising. You're now public. You have a lot more responsibility, reporting requirements, but you're not done. You still have to generate a return for your investors. So types of investors, we kind of talked about this earlier. There's the friends and families. They typically are passive. They're typically one and done. Angel investors, they may or may not add some value depending on who they are. They may also be one and done. The one thing about individuals that I've learned over my career is, circumstances change. The stock market goes down. They're not feeling as wealthy as they once were. Maybe they got divorced. Maybe they got sick. Maybe they decided to go buy a boat and sail around the world. But their circumstances change. So you can't necessarily count on them to invest in successive rounds. Institutional investors, on the other hand, expect and plan to raise in additional rounds. And you want institutional investors that are thinking that way. They can also bring, hopefully, domain expertise to add value in the form of advice to you, intros to customers, strategic partners, introduce you to other investors, help you recruit management, help you recruit board members, and help fund future rounds. So there is a cost, as we talked about earlier, in terms of the command and control provisions, but there's also a big benefit if you get the right investors. More advice. This comes up all the time. If you are asked, if you're talking to an investor and they seem interested, and you are asked what kind of valuation you're looking for, do not answer that question. Don't answer that question. What you're trying to do is get them to invest in the company. You don't want to give them reasons not to. I'll give you an example. I was in a meeting. This actually just happened. I was in a meeting with a CEO, and this is a guy, he's been in startup companies before. He's been very successful raising money. The meeting was going really well. I actually thought the investors seemed legitimately interested. This question comes up. The CEO knew not to answer the question, but he obviously was feeling confident, and he blurted out a completely unreasonable, I don't know where he came up with the number. It was completely unreasonable valuation. I almost choked. Anyway, needless to say, end of meeting. We never heard from those guys again. Because again, if you're a VC and you only have 2 investments that you're going to make in a year, do you want to invest in a team that seems reasonable about the valuation and expectations of what they can achieve? Or do you want to spend your time talking to a guy who has no idea what the market value of his company is, and it's going to be a hassle like working with him because he just doesn't know what he's talking about? It's a very quick way to end the discussion. So don't ask that. I always tell people, appeal to the ego. Everybody on the investment side has an ego, right? Appeal to the ego. You can get money from anybody. We want money from you. And the reason we want money from you is because we know you can really help us. You can help us with all the things that we need help with, such as finding other investors, giving us advice, finding us strategic partners, customers, so on and so forth. And so you need to know a little bit about the investor, what they've done before, what their background is, but really kind of appeal to them on a personal basis that, we want to work with you. And you can add that, listen, we're going to be reasonable about the valuation. We're not trying to get the best deal. We're trying to get someone that can really help us grow the business. Okay, some of the things that you need to know when you go out fundraising. Value is defined by the customer. Know what's important. We talked about faster, cheaper, better. You need to know what your value proposition is. You need to know what market segment you're going to go after. Where is the technology most useful and for what purpose? You need to be able to articulate this value proposition. Investors are going to give you a lot of money. What are you going to do with it? And the benefit, think in terms of benefits to the users. Why is it that they are going to use your product versus someone else's? What would cause them to switch from a current practice to your product, process, or service? Estimate the revenue potential. How much is it going to cost to make, and how much do you think you can sell it for? That's your profit. That's going to lead to your cash flow. How much money are you going to need to get there, right? Formulate the competitive strategy by which you're going to, gain and hold an advantage over your rivals. What's your first target market? So you have to have a knowledge of the price, your costs, your margins. This all plays into why you're a worthwhile investment. I mean, investors aren't going to invest with you because out of the goodness of their heart, they want to make a return. Yeah.
So, yes, and most people in here are interested in biomedical type products, but this applies to anything. But when it comes to biomedical, it's very reimbursement driven by the HCPCS codes and all that sort of stuff.
Right.
Related to insurance. What resources does GRA, Biolocity, Emory Georgia Tech, whatever in the ecosystem have to get inside that opaque box of HCPCS reimbursement amounts to see how much is a reasonable amount to charge for your product in comparison to what is already on the market.
Yeah, so there are existing codes that you may apply or be eligible for. That obviously makes it easy if there's an existing code, because then you kind of know what that reimbursement looks like. If there's not an existing code, obviously applying for a code, that's not a lot of fun. Yes, it takes some time, but there are folks out there that can help you. I don't personally have a lot of experience in that, but there are consultants that can help navigate that. So yeah, we could probably put you in touch with people that.
Website somewhere you can find that.
CMS back to us. Specific advice about how to finding those
But like for Velocity, if we had a team that was in the process and we really felt, I mean, sometimes things are really needed later on in where you're going. So we're not going to invest in the money to find out that information, because we need to see, do you have your killer experiment, that kind of stuff. But if we, for example, we had someone in our program and they got to a stage and we agreed that this information was really critical to help the team get follow-on funding for the next stage, that's something that we can invest in one of our consultants to start that process through. Or to give you, oftentimes it's maybe a very high level view of it, so that you have an idea of what you're going to get from CMS or not. And then you can, with future money, go deeper. Like go, no go ideas.
Right. Okay, so we talked about this before, but some of the things that venture investors and angels are going to be looking at, what problem are you solving? We talked about that, but management, that's key, right? Does the team have the requisite knowledge and experience to execute the plan? Are they committed? You're not going to do this by yourself. You need to be able to recruit people that can really help you get there. People that have been there, done that before. The market, how big is it? What's the competition? Think about everything a business does. You've got to make it. You've got to sell it. You somehow have to distribute it to your customers. You're going to have to service it. There may be returns. Hopefully not if it's implanted in somebody. But you got to think about everything that goes into a business. Technology we talked about. Is there IP? Who owns the IP? Financial, what resources we needed. Talked about the regulatory path. And then investors want to know, what is your exit strategy? What do other companies that are similar to yours or in the field, how long did it take them? What size did they have to grow to before they generated an exit? What did that exit look like? So having comparables that you can point to show that potential return that you're going to generate for them is very helpful. And then just a couple of quotes from some people you may not have heard of before. But Thomas Edison, I have not failed, just found 10,000 ways that it won't work. And Albert Einstein, you never failed until you stop trying. So that's it. Any other questions? Thank you. Hope it was useful.
I have a generic question. Most people on Zoom and here are interested in med tech or med device or diagnostic or therapeutic. What specifically about the fund, particularly the slide about when you're looking for friends and family, angel, institutional, how does thinking about this regulated market change the way you approach fundraising?
Well, from my perspective, it doesn't. You need to get the money to get done what you need to get done, right? But certainly from when I think, so the GRA in my past life, when we looked at deals, I did think about it, go back to that slide. These are the kind of the thing, because we kind of looked at so many different companies and technologies, I would try and assess them based on these factors here, right? So, and this obviously doesn't apply to all deals. There's some deals that don't have a regulatory component to them. So this gets added if it's a med device or something in the life science space, right? So hopefully you have investors that are knowledgeable about that and comfortable with that. You may have to explain that to them. But you know, friends and family, they're going to be investing in you. They're not necessarily going to know what the regulatory risk is or have any way to assess that. That's what makes it challenging about taking money from friends and family, because if a company fails or you lose money for them, these are your friends and family, right? Yeah, it might make it for more interesting next time the family gets together for the holidays. You may be eating dinner outside. I don't know. But they're investing in you, and for that matter, all investors are investing in you, and the management team is the most important consideration.
We do have a few questions from Zoom.
Sure.
So first is there any advice for fundraising if pre-sales are not possible, showing market validation? For example, if your product is
Yeah, so that's an interesting question, because for the early stage companies that I deal with, you're really investing on a vision and the potential. And a lot of times it's easier to raise money on vision and potential if you can convey a compelling story. Once you have sales, now you're being judged based on the sales and the financials, and you're being judged based on reality and cash flow and what's your runway. So it's a very different pitch in effect. And so having pre-sales or any sales, changes the way people look at you.
You're saying it's almost easier to have no sales.
I would argue in some cases it's almost easier to have no sales, right?
And also being selective of who you're selecting as your partner and how they're used to identifying value inflection points in that type of environment versus maybe a software company that they're really looking for traction and stuff like that.
Now listen, I should qualify what I just said. It depends on the stage of the company. If you're out raising if you've already raised, $20 million, you're on Series D, whatever, at some point you gotta perform, right? So I'm talking about the very earliest stages. It may be easier, but so hopefully that's clear.
Yeah.
Anyway, go ahead. Yeah, go ahead.
Quick questions based for all engineers, or engineering background. I had a quick question on, there was a professor here at ECE a couple of years ago where he creatively financed for his startup using research funds for his startup, and was initially rated by the GBI.
For the people on Zoom.
Yes. I had three quick questions. One, how can we structure our research so that we do not get any negative outcomes? I think this is primarily for Georgia Tech, because as far as I've read, only Georgia Tech professors are under a lot of scrutiny from a criminal standpoint. There was a professor in ECE, Joy Lascar. He got vindicated, but in my mind and from what I read, it seemed like he was completely surprised by the GBI raiding his house. The second question has to do with, you mentioned the bandwidth of being able to manage a fund and maybe having 8 companies that they could properly manage from a general partner perspective.
Per partner, yeah.
Are there any other ways to get a better idea of the dynamics of the fund that you're interested in based on the vintage size of the fund and the dynamics of them not getting to any liquidity events and so on and so forth, so you can kind of cross-validate the actual genuine collective mind state of the fund, of what you're really dealing with? Because maybe if they haven't had any exits, perhaps, and they're on multiple boards, maybe you need to go to someone else or blah, blah, blah. And the last question has to do with new ways of research funding, using structured products. Have you heard about this? Have you seen this in any other areas where they're using structured finance for medical research?
I've heard of Joy Lasker. I'm not sure I know the details related to that, but, and I wouldn't say it's just Georgia Tech. This applies to any school, right? But if you're an employee of the university has the rights to the technology. You're typically disclosing to the university what you're working on. They make an assessment of it and they decide what they're going to patent, what they're going to invest in fact. They may release that technology to you if they choose not to pursue it. But you want that in writing, obviously. If they release it to you, then it's yours. But if they decide to pursue it and file a patent, then when you create a company, you need to license it from the university. So the ownership path, that documentation needs to be clear. In fact, investors that's something they're going to look at, right? They want to make sure they understand exactly who owns the rights to the technology and for what purposes. So again, I don't know the details related to Joy Lasker. Maybe you may know better, but if you follow for every one of him, I mean, again, you saw the slide about how many projects we've invested in, and it's not just Georgia Tech, universities, research universities around the state of Georgia. That was a kind of in my own opinion, a one-off. Well, we don't see that every day, right? You do need to be cognizant of it, but it shouldn't. I wouldn't say it should be a disincentive to start a company. You just need to make sure you follow the rules of the institution you're dealing with. So that was question number one. With regard to the fund, so the best time to approach a venture fund is when they've just raised money, because they have money to deploy. And they usually make announcements. We just raised X dollars in fund 3, 4, whatever. And general partners generally have domain expertise in the areas in which they invest. The GRA Venture Fund is a little unusual because we invest in all technologies that come out of the universities here in Georgia. As a former partner of mine, you like to say, it was everything from A to Z, aerospace to zebrafish. We saw it all. And we would look at it all and consider it all. But most venture funds don't work that way. Most venture funds, much like a startup company, they have a particular strategy. We're going to invest in this sector because we think this has the most growth opportunities. And they're trying to find, in effect, they're betting on a horse race, right? And they're going to bet on multiple jockeys. But the general partners generally have domain expertise, and that's what they're going to focus on. And so if you go to the website or LinkedIn, you'll see the GP background, you'll see what companies they're on boards of. You'll say they typically will list the companies that they've invested in, so you can kind of see what they like. So you can kind of see if you fit their profile. And then with regard to the stage, there's really no way to know where they are in the life cycle, but most of the time, VCs will invest the money or commit the money over the first 5 to 6 years after they raise a fund. And they're typically raising a fund, the more successful firms, probably every 2 or 3 years. So they usually have money to deploy. But again, as they say, as soon as they've raised a fund, they got money to deploy. If they haven't raised a fund in 4, 5, 6 years, they're probably nearing the end and may not be looking for as many new investment opportunities. They may be looking to reserve what they have to support their existing portfolio. So you can kind of estimate based on that. Yeah, PitchBook's another good source. Do the students have access to PitchBook here?
Yeah.
It'd be something, as you were talking about with the chat here, about going to tech transfer office and talking to them as well as what kind of resources are available.
This data's out there.
Yeah.
Yeah. And you can also, when you see, and I encourage people, if they're considering working with a fund, if they can see the companies the fund has invested in, going and talking with the executive team of those companies to find out how collaborative they were and those types of things. Because going back
Yeah, that's an excellent point. I mean, they're going to do a lot of diligence on you. You are allowed to do diligence on them. And you should. You should ask them who they invest in. You should talk to the CEOs of the companies they've invested, see if they were collaborative or more. Yeah, exactly.
We'll end it there.
Oh, were there any other questions? Any quick ones? Okay, I'm happy to stay around if, I don't know if they can, I'm happy to stay online and try and answer them as well. So,
Sure. So if you have continued questions, we will answer the last few questions. And then, but if you need to go, please do. So one question is a question specifically about GRA. Is there a place for GT alumni-run medical device startups to receive funds through GRA, or does the startup research need to be currently conducted within a university lab?
it's more a function of who owns the technology. If Georgia Tech owns the technology, then they're eligible to receive funding from the GRA.
All right. And then this is maybe you could expand upon, could you please explain a little more about, quote, if you want advice, ask for money. If you want money, ask for advice.
That's it's a euphemism or an adage. I found it to be true over the years. But if you approach an investor and ask them for money, they're likely to give you, they may hear you out and they're likely to give you some advice about what you should be doing. And the best way, I think, to approach a potential investor, say, hey, I'd love to talk to you about something I'm working on, get your advice, get your thoughts about how next steps, what I should go forward. It gives you an opportunity to tell them about what you're working on without asking them for money. And then if you can pique their interest, they actually may offer an investment.
It's like a psychological
It's
approach.
a little bit of a psychological approach, exactly.
Do the investors know this?
Well, no, if you're in the VC business, they're accustomed to people coming to them asking for money. That's what they're in the business for, right? So, but if you're not in the VC business, let's say you're an angel investor or an angel network, then yeah, they're not necessarily thinking that way. So, yeah, I think it's an interesting way to at least initiate the conversation, a non-threatening way to initiate the conversation, actually a flattering way to initiate the conversation. I'd love to get your advice. Would you mind if I buy you a cup of coffee? Let's talk about this. Have any thoughts for me? Any advice about where I can go to get money? Do you know anyone who has some money that might want to invest in this? You know, they may start.
Logically, but on this front, you're immediately thinking of reasons you're not going to give them money and a little bit more defensive. If someone comes and asks you for advice, you're like, wow, they think I'm smart. They're asking for advice. I want to see how I can help them along this way.
It's no different than my approach about appeal to their ego. Everybody's got an ego. So
Nice. All right, we'll end it there. Thank you, everyone. We will send out slides and a recording in a few days. Thank you.
thank you all. Hope it was helpful.
So you